Both a Roth IRA and a traditional IRA are individual retirement accounts. They both let your money grow completely tax-free while it sits inside the account. The one big difference is when you pay taxes. With a traditional IRA, you pay taxes later. You put money in today, and you can deduct that contribution from your taxable income this year. So if you contribute $7,500 to a traditional IRA and you are in the 22% tax bracket, you save $1,650 on your taxes right now. That feels great. But when you retire and start pulling that money out, every dollar you withdraw is taxed as regular income. With a Roth IRA, you pay taxes now. You contribute money that has already been taxed. You get no deduction today. But when you retire, every dollar you withdraw is completely tax-free, not partially tax-free, 100% tax-free, including all the growth your money earned over the years. So here's the simple way to think about it. Traditional IRA, pay taxes later. Roth IRA, pay taxes now, never again. The question is, which timing is better for you? Now let us talk about the 2026 rule changes, because these are important. The IRS increased the IRA contribution limit for 2026. You can now contribute up to $7,500 per year. That is up from $7,000 in 2025. And if you are 50 or older, you get an extra catch-up contribution of $1,100. That brings your total to $8,600 per year. For someone in their 40s, that catch-up provision kicks in very soon, if it has not already. Now for the income limits. Roth IRA. Not everyone can contribute directly. If you are single and earn more than $168,000 in 2026, you cannot contribute to a Roth IRA directly. The phase-out starts at $153,000 for single filers. For married couples filing jointly, the phase-out starts at $242,000 and cuts off at $252,000. Traditional IRA. Anyone with earned income can contribute. But whether your contribution is tax-deductible depends on your income and whether you have a workplace retirement plan. For 2026, if you are covered by a 401k at work and you are a single filer, your deduction phases out between $81,000 and $91,000. For married couples filing jointly, it phases out between $129,000 and $149,000. Welcome back to Capital Roost, where we make smart money decisions simple. If you are in your 40s, retirement is no longer a distant idea. It is 10, 15, maybe 20 years away, and the decisions you make right now about where you put your retirement savings will have a massive impact on how much money you actually keep. Today we're going to cover three things. First, the core difference between a Roth IRA and a traditional IRA. Second, which one makes more sense depending on your income and tax situation. And third, the key 2026 rule changes you need to know before you contribute this year. Let us start from the beginning. What if your income is too high to contribute to a Roth IRA directly? There's a legal strategy called the Backdoor Roth IRA. Here's how it works. You contribute to a traditional IRA, which has no income limit. Then you convert that traditional IRA into a Roth IRA. You pay taxes on the converted amount, but going forward, all growth and withdrawals are tax-free. This strategy is completely legal and widely used by high-income earners in their 40s and 50s. Just make sure to work with a tax professional before doing this, because the rules are specific. Here are three quick practical tips before you contribute this year. Tip number 1. If your employer offers a 401k match, always max that out first. Free money beats everything. Tip number 2. If you cannot decide between Roth and traditional, split your contributions. Put some in each. This gives you tax flexibility in retirement. Tip number 3. Set up automatic contributions. Even $100 per month to a Roth IRA today compounds significantly over 20 years. This is the question that matters most for someone in their 40s. And the honest answer is, it depends on one thing. Do you expect your tax rate to be higher now or higher in retirement? Let me walk you through the two most common situations. Situation number 1. You are at or near your peak earning years. You are making good money. You are in the 24% or higher tax bracket. In retirement, you expect to spend less and be in a lower bracket. In this case, the traditional IRA often wins. You get a real, meaningful tax deduction today when your bracket is at its highest, and you pay taxes later when your income and your rate will likely be lower. That is smart tax timing. Situation number 2. You are mid-career, but your income is still growing. You expect raises, promotions, or other income in the years ahead. You think tax rates overall may go higher in the future, given the national debt situation. In this case, the Roth IRA often wins. You pay taxes now at today's rates, and all your future growth and withdrawals come out completely tax-free, no matter what tax rates look like in 20 years. Here is the key insight most people miss. For someone in their 40s, the Roth IRA is especially powerful because of time. If you contribute to a Roth IRA today, your money has 15 to 20 years to grow completely tax-free. On a $7,500 contribution, earning 7% annually, that becomes over $29,000 by retirement. And you pay zero taxes on that $21,500 in growth. Zero. Let us bring it all together. Roth IRA, pay taxes now. Withdraw tax-free in retirement. Best if your income is still growing or you expect higher taxes later. Traditional IRA, deduct now. Pay taxes on withdrawals in retirement. Best if you are at peak earnings and expect a lower bracket in retirement. And in 2026, you can contribute up to $7,500 or $8,600 if you are 50 or older. That money, invested consistently over the next 15 to 20 years, can make an enormous difference to the life you live in retirement. The best account is the one you actually open and fund. So pick one today, set it up, automate your contributions. Your future self will thank you. If this video gave you clarity, please give it a like. It genuinely helps this channel grow. And if you want clear, honest financial guidance every Sunday, subscribe to Capital Roost. See you next week. Here's a question that could be worth thousands of dollars to you. Are you putting your retirement money in the right account? Most people in their 40s are contributing to either a Roth IRA or a traditional IRA. But very few people stop to ask, which one is actually better for my situation right now? And making the wrong choice could mean paying tens of thousands of dollars more in taxes over your lifetime. Okay, no jargon, no confusing tax code language, just a clear, honest answer for where your money should go in 2026. Let us get into it.